Preferred stock is a unique security that acts like a bridge between common stocks and bonds. Let's look at how it works. It is often called a hybrid security because it shares features of both equity ownership and fixed income debt instruments. The most defining feature is the dividend. Shareholders receive a set payment amount regardless of the company's fluctuating stock price. Preferred shareholders get paid before common stockholders, but they usually give up the right to vote on company matters. While common stock offers growth, preferred stock prioritizes income stability and claim preference during a corporate liquidation. If a company goes bust, bondholders are paid first, then preferred shareholders, leaving common stockholders last in line for remaining assets. Many investors look at these instruments primarily for the steady income stream, rather than the hope of capital appreciation. Understanding these nuances helps you better evaluate different asset classes. Subscribe for more basics, educational content, not financial advice.